Hello there, welcome to this edition of Global Business Africa. In the next half hour, we'll take you through a run of all the key business news stories you need to know about from across the African continent happening today. Here's what's coming up. Who's hot, who's not? We'll be looking at the 2014 edition of the Africa Prosperity Report. Zimbabwean officials are dropping hints about changing the indigenization law to draw in more FDI. And a metal sculptor in Benin is carving a niche for himself in the country. We'll tell you how. Now, we're all data hogs, at least on the business team in this particular part of the world. So when a company comes along and drops a whole bunch of data in Africa, especially when it comes to prosperity on you, we turn into very happy campers. We know about the obstacles that block Africa's economic development, but what about the facts that determine the quality of your life? Well, we got our hands on a report that looks at something beyond the usual set of economic indicators, and it has come up with some fairly interesting results. Here's Volder Kirelsa with the highlights from the 2014 Africa Prosperity Report.
The report's produced by a Dubai-based investment firm. Their basic finding is that African nations have made progress in the past 3 years, but it's a very mixed bag. Let's take a look at the findings. Botswana comes out tops as the most prosperous. That's what years of peace, stability and diamonds can do. But the ongoing conflict in the Central African Republic leaves it at the bottom. Southern Africa rates highest for education and governance, but as for personal freedom, it's grim up north. Egypt ranks last, marked down for alleged intolerance towards immigrants and minorities. But East Africa is making the biggest gains in improved prosperity. Rwanda is a particularly strong performer. But security in the region is a growing concern. Security, too, is a worry for North Africa. Africa's biggest economy out of the 38 countries in the survey, Nigeria is ranked 35th for safety. But Burkina Faso leads the field in education. Now that could mean good news for its future economic growth. Liberia comes last, thanks to a drop in enrollment. And the Ebola crisis is almost certain to make matters worse. So if you're planning to migrate anytime soon, it's well worth checking this report before you make your decision.
Now then, the fall in global oil prices will cut Egypt's fuel subsidy bill. But at the same time, it could hit the finances of oil exporting Gulf allies who have donated billions of dollars in aid to the country. Oil prices have dropped dramatically in the last 6 months. Brent crude was trading at about $60.91 a barrel earlier on Tuesday. If it stays at that level, the government expects to save about $4.2 billion in fuel subsidies for its 86 million people in the 2014-2015 fiscal year. But that, however, is less than half the total in Gulf aid that it received in the last fiscal year alone. Economists say the situation is a double-edged sword for Egypt as oil prices drop Gulf patrons' ability to continue funding Egypt. The global prices are now hovering near 5-year lows. Analysts say they would have to fall much, much lower for a lot longer before Gulf countries would then have to cut aid. On to Zimbabwe now, where the acting president has hinted at the country's indigenization laws being changed early in 2015. The acting president told a delegation of business executives that the government would review policies to attract more foreign direct investment. Here's Farai Makutuya with more.
One of the captains of industry who met the newly appointed vice president over the weekend says they were told the economy would be government's top priority in 2015. Zimbabwe's economy is stagnant and will grow by 3.2% in 2015, similar to 2014's 3.1% expansion. A crippling shortage of liquidity is the main cause of the problems, and many here believe this can only be solved by more foreign cash inflows. But those have been held back by indigenization laws that are perceived to be unfriendly. President Mugabe has previously said there would be no backtracking on the law, but recent moves by his government suggest otherwise. While presenting the national budget last month, Finance Minister Patrick Chinamasa announced the time frame by which the 51% threshold should be reached is now negotiable. And now the Vice President has alluded to further relaxation on the way.
They are looking for a compromise position where those who come to invest here are reasonably happy that their investment is safe. I don't believe that what we're seeing is backpedaling on the part of government. It's just a review, it's a reassessment to see exactly where the sticky points are and smooth those out.
In another policy review, government has amended labour laws to introduce productivity-linked wages. The high cost of labour had been blamed for pushing up the cost of doing business here and driving investors to settle in other markets. But there are long-term benefits. But that move may not go down well with workers' unions here, who claim that employees are already being paid salaries below the poverty datum line.
Workers need to think about that. Is it in their interest to hang on to high wages right now and stifle progress or stifle development, or shall they accept some bit of flexibility without being obviously being exploited?
The policy changes are in line with government's 5-year economic recovery plan, which promises 2 million jobs. Fare Mwakutuya, CCTV, Harare, Zimbabwe.
Let's talk about capital gains tax. The last time it was charged in this country, I wasn't even born yet. You see, fear sparked by the reintroduction of CGT in Kenya, now pushing the Kenyan main index to month lows. The country in August introduced a 5% tax on net gains accruing from transactions in property and securities like bonds, shares, houses, land and so on. And that comes into effect on the 1st of January. Traders are now citing uncertainty in the market over how exactly the tax will be implemented to a string of offloading that's been seen in the last couple of days. The NSE 20 share index, an indicator of overall market performance, has dropped 6% in the last 4 weeks.
You can't attribute all the drop to it because we've had very uncertain global markets. We've had an infection in the Nigerian oil share, for example. I think we got some contagion, some spillover from that coming into our market. And then on top of that, the capital gains tax announcement put everyone on the back foot. We saw some big trades done at some discount to the market, and that sort of further fed in on itself and created this run lower, which actually stabilized today. The market turned a bit higher.
All right, but looking forward though, I mean, the way Kerry and the Finance Ministry have said this will work, stockbrokers, as I understand it, are responsible for collecting CGT and then remitting that on to KRA. Will it work?
I don't think it's operationalizable in its current format. I can't think of any stockbroker who's going to do a business as a collection agent. So I think fundamentally it's got an issue at the get-go, and I think that is something that will play out in the first quarter, in the first half. But I do not see the capital gains tax being applied to the stock market in its current format. Real estate, probably quite different.
Why would it be different in real estate and
because you're not going to have a collection agent. I don't think you have a collection agent there. People are going to have to remit. They're going to have to give their accounts in, and I think that is a more normal procedure in these sorts of matters.
But what about withholding tax? Because the argument Kerry could make is we had withholding tax in play for quite a while, and in that instance, companies had to remit that anyway. So why would it be so difficult for stockbrokers to remit CGT?
Well, it's a fair point, and I'm sure that's the point that's going to come back. My impression is, stockbrokers, they're in the business to do business at the stock market. They're not necessarily in business to be collecting taxes, and I think that's the fundamental issue. I don't think they're going to be sufficiently incentivized to be doing that.
But there's also another fundamental issue here, because CGT essentially targets the person who's disposing of the asset, and stockbrokers just sit in the middle of that chain. They're not the ones who own the assets, or because they don't trade on their own accounts anyway, and they're not the ones who own the assets as well.
And the other thing is, they're not in the business of necessarily keeping records on each transaction in a methodology that's going to work for the taxman. So I think we've got a fundamental problem here. I don't see how this can be implemented in its current format. I think that's largely recognized by everybody, and therefore I think the market has gotten a little bit too nervous ahead of this. I think it's not helpful for the capital markets or the stock market to have this tax introduced now. As far as I can see, the collection rates are not going to be sufficient out of the stock market, and I think the government would have done well. We've sold $2.75 billion dollars worth of bonds. We want to keep the foreign investor interest in the market. I'm not sure it was necessary to do it right now.
All right, let's go back to something that you said in September when
Yes.
Uhuru Kenyatta signed the Finance Act into law, and you said that, look, it's 5%. It's a nominal
Yes.
rate. It's not really going to put us in a difficult spot. Uganda's got 30% CGT, Tanzania's got 25% is a small drop in the ocean.
Yes.
Do you still stand by that
Well,
statement?
I think that's right, and I think that's why it was introduced in that way, because the optics allow you to think the way I was thinking a few months back. Having looked at the market behavior in the last 3 months, you know, we had what was a very liquid market, huge appetite for African Eurobonds, a lot of appetite for African credit. That's turned quite dramatically in the last few weeks, in part because of the oil price collapse. And I think in these circumstances, I'm not so keen on this capital gains tax.
My conversation there earlier with Alkan Sachi, CEO of Rich Management. Let's do a recap of our initial story, the Africa Prosperity Report of 2014. Fairly interesting numbers coming out of that particular report. Botswana right at the top. Some interesting data coming out of Egypt, but we'll get to that a little later. Right now, we're joined on phone by Novella Bottini. She's an economist at the Legatum Institute. She's one of the authors of this report as well. Thank you for your time. Very briefly, walk us through the methodology used in this report. How was the data put together?
Hi. The data for the Africa report are based on the data from the Legatum Prosperity Index. It's an index that measures prosperity, and it covers 142 countries using 89 variables. And the index covers both objective and subjective dimensions. All our variables are taken from official data sets. So, for example, for the objective variables, we use the World Development Indicator. Our information on mobile and communication are from the ITU dataset. Our variables for health are from the WHO. Our variables for the governance sub-index are from Freedom House. In addition to these objective variables, we have a set of subjective variables. Because the aim of the index is to measure prosperity, both for the country, but also individuals. And so for the subjective variables that are very delicate to measure, we use the Gallup data set that is a survey that covers more than 142 countries around the globe. So what we have done is just we took the African countries from this set of worldwide countries, and we create a ranking from African countries.
Indeed. Thank you for your time this evening. We've been speaking to Novella Bottini. She's an economist at the Legatum Institute, one of the authors of that report. If you can find a copy of it online, it's definitely worth the time just sitting down and reading that in particular. Now, one of the things that the report focused on very strongly was the participation of women in the workforce as entrepreneurs, as labour. That, of course, the report argued was one of the most underexploited elements of human capital across Africa right now. Let's get some insight on why that is the case. Yasser Kim is live on the line from Cairo right now. Yasser, according to the data contained in this report, why are there so few female entrepreneurs in Egypt? What sort of social and economic obstacles do they face in trying to set up their own enterprises?
Right. First of all, you have to know that the environment here is very hostile, the business environment. So it's hostile generally. So imagine with women, with the gender inequality going in. So any newcomer into business will find problems. So that's one side. Then you've got the inequality in women are not have access to education as much as men, especially training skills for entrepreneurship. They don't have, for social reasons, also time for business as men. They have more, especially in the middle to lower class sects of the society, they're more into the home, taking care of the family, rather than going out to open her own business, maybe work, but not as an owner. So you find a small percentage of women in the business. You've got as well the lack of finance after 2011 uprising, the economic situation, the recession in itself. So we've got lack of finance for women to open new businesses. businesses. So it has dropped significantly for women for reasons that are social, like I mentioned, and also economic and business environment, which is in itself hard to open a business now.
Indeed, security, or more accurately, the lack of security, is a bigger concern, according to some of the surveys that fed into this particular report, for Egyptian women, especially after 2011. What's being done to improve safety and security, especially for women?
Right. If you talk generally, you've got now the army has interfered in the security issues now, and it's working out with the police how to maintain security around cities in Egypt. So that's on the general frame. On women, women in Egypt have been subject to harassment and issues concerning security. And what the government did is that it has had made new laws, harsher, very harsh laws for harassment against women, and it could lead to a death penalty for rape, but for harassment it can lead to 5 to 10 years in jail, just which was before mainly just a fine, money paid just to go out. But there are harsher penalties now for attacks on women or any kind of harassment on women, and more security apparatus working harder to secure the streets. It's not back to the pre-2011 security yet, but it is developing rather better than 2012 and 2011, but not yet back to normal.
Indeed. We'll have to leave it there for the time being. That's Yasser Hakim live from the Egyptian capital of Cairo. Let's make a quick run through equity markets here for you. Picking up on a theme that Ali Khan mentioned in that interview a little earlier, the Nairobi 20-share index stabilizing after that 6% slide we've seen in the last 4 weeks. 4907.27 is a closing number today. The recovery is still very much on in Nigeria. The stock exchange, the all-share index over there, up by about 4% in trading today. Keep in mind, though, the year-to-date losses of over 15% so far on that index.
Sustainable development and a commitment to developing partnerships with Africa. Some of the key phrases already used at the Africa Global Business Forum here in Dubai.
There is a need for a predictable environment in which investors have to put their money.
Welcome back to the program. You're still watching Global Business Africa from the Kenyan capital, Nairobi. Djibouti has been registering quite a bit of economic development over the last decade. Under its Master Development Plan, Vision 2035, the nation wants to accelerate overall GDP growth. Now, the country's invested over $9 billion in several ports and supporting infrastructure to get its vision underway. Gurum Chalo was in the tiny Horn of Africa country. He compiled the following report.
3 specialized ports are currently under construction here. Djibouti wants to ride on Ethiopia's fast growth to boost its own economy. Under the nation's 2035 economic blueprint, all new ports are designed based on Addis Ababa's needs.
We cannot design our long-term and mid-term vision without considering the different scenarios, the different scenarios from Ethiopia development, not considering the challenge in Ethiopia or the potentialities and opportunities in Ethiopia in our own long-term and mid-term vision.
And so the port of Dorale, the port of Tajura, both under construction, will be used for purely a container terminal and exporting potash respectively by Ethiopia. However, the over $9 billion projects in the smallest country in Africa are beyond building ports. New railways, airports, highways, as well as power substations are now under construction. The projects are financed by Chinese companies and banks.
It's something we're supposed to do in the past, a long time in the past, in several years. So now we get the opportunity and the funding. We want to achieve all this infrastructure development in a short time, 3 to 5 years.
This port under construction has a capacity of holding 2 vessels 200 meters each. It is due to be completed in 2016 and it is expected to strengthen the service delivery on the seas here in Djibouti. Over the last decade, Djibouti's economy has been growing 5% on average, and the current projects underway will assist the country register more growth in the coming 10 years as well.
They are building a new road from here towards the north of the country, and they are thinking about the railway coming always from the north of the country. And so it will be a very useful project and very useful way of achieving this kind of development.
The private sector is not left out of this growth activity either. Companies like DP World are now operating in Djibouti, investing hundreds of millions of dollars.
The government basically is secured as a shareholder. However, in terms of managing the whole activities A to Z is basically by the private sector. So that allows the company to explore its own expertise, its own initiatives to manage the efficiencies, to bring up customers and to make sure that it markets. So that's a good example, and if it's the same applied on different areas, it's going to, I think, bring up the same advantage to each and every business sector.
Grumchala, CCTV, Djibouti.
Let's make a quick run through commodity prices here for you. Crude oil still hovering around $60 a barrel. Nigerian crude, of course, is benchmarked to Brent crude. Worth noting that its exports in February, according to shipping lists out today, will actually fall to about 1.87 million barrels of crude a day. Should be fairly interesting to see, of course, with a look at the government, the effect that will have on government income and government revenue moving forward. Next, we'll be introducing you to a sculptor who's carving quite the niche for himself in Benin. All that and more is coming up next. Welcome back to the program. Now, it's not rare to find a wealthy artist in Benin. Artifacts from the country have proven to be quite popular, with visitors offering a way out of poverty for many an artisan over there. Many, however, will admit that it's not an easy path to take, and only their passion sometimes keeps them going. It's that same passion that has driven 25-year-old Philippe Zout into the rare form of art of carving forms out of metal.
Art is a form of expression, and for artists on the continent, it is not only a way of telling the African story in a unique way, but a source of income. Philippe Zout has ventured into metal carving, which, unlike other forms of art, requires rare skills and the patience to carve out every detail. He recently showcased his pieces at an exhibition in Cotonou, Benin, and the response was very good. He says that there are many sources of inspiration and he will churn out many more pieces.
Today, given the evils plaguing the world, there is no difficulty to find inspiration if you are a real artist. Every country has its problems, and at the top, you have deforestation, ozone layer degrading. All that is trouble, and there are many others bringing war in Africa and in the world. Those are elements which can lead an artist to produce artwork through which he can express himself.
His inspiration came from his uncle's workshop, where he learned how to work metal after his professional training in metalwork.
At
the beginning, I was a blacksmith. I would say because I was working in my uncle's shop, my uncle was a blacksmith, and there I started loving metal. If I can work out those sculptures today, it's because I went through welding courses that gave me the skills to handle metal.
So impressive has been his works that his latest exhibition was hosted by a fan.
I love everything that is art, and I'll always say that we must encourage artists. As far as I can, I help. In being my modest contribution, I've agreed that my house, or at least my garden, can host the exhibition.
Zuntanyi's subjects and his unusual materials have created a great deal of interest from the Cotonou public, and he encourages others with similar skills to venture into the rare form of art. Maria Galang, CCTV.
Let's make a quick run through our currency markets here for you. Not much change from the numbers that we were looking at a little earlier in the day. The Kenyan shilling still hovering around the 90.25, 90.40 range, especially in the next 2 weeks, because trading is going to be so thin, these numbers will barely change. Right then, here's what we're working on for tomorrow's program. We will be in Uganda. We'll be looking at the government's attempts to curb cybercrime in that part of the world. We'll also be looking at new ideas for decking out your Christmas festivities, eco-friendly Christmas trees in Cape Town, for example. All that and more is in the pipeline, so we'll be coming your way in tomorrow's edition of the program. But that's it for today's part of Global Business. Do send your feedback to Global Business Africa at cctv.com. And of course, when we're not on the air, Facebook and Twitter are your ports of call. We'll see you in the next 23 hours. I'm Ramanya.